UAE OPEC exit, what it means for global oil markets, prices and power. A shock to the oil cartel. The UAE's decision to exit OPEC after nearly 60 years delivers a major blow to one of the world's most influential energy alliances. OPEC, which historically coordinates production among major oil exporters to influence global prices, has long depended on unity among its members. By withdrawing, the UAE, one of OPEC's largest producers, undermines that unity and raises questions about the group's long-term cohesion. Analysts say the move highlights growing internal fractures, particularly between the UAE and Saudi Arabia, OPEC's de facto leader. Why the UAE is leaving? At the heart of the decision lies a strategic calculation. The UAE has increasingly chafed under OPEC production quotas, which limit how much oil member states can produce. Despite having capacity of nearly 5 million barrels per day, it has been restricted to significantly lower output levels. Officials say the exit reflects a long-term strategic and economic vision, allowing the country to pursue independent production policies and expand output in line with its growing capacity. In short, the UAE wants flexibility, something OPEC's coordinated system does not easily allow. Timing, a market already under strain. The timing of the exit is critical. It comes amid a global energy crisis triggered by the 2026 Iran conflict and disruptions in the Strait of Hormuz, a choke point through which roughly 20% of global oil supply normally flows. These disruptions have pushed oil prices above $100 per barrel and created extreme volatility. Because of this instability, analysts say the UAE's exit is unlikely to have an immediate dramatic impact on prices. Supply is already constrained, and additional UAE production cannot fully reach the market until geopolitical conditions stabilize. Short-term versus long-term impact. Short-term, limited immediate effect. In the near term, oil markets are dominated by geopolitical risks rather than structural supply changes. Experts suggest that despite the headlines, the UAE's departure will not drastically alter prices right away. Long-term, more supply, weaker OPEC. The bigger impact lies in the future. Once regional tensions ease, the UAE is expected to increase output significantly, potentially adding substantial new supply to global markets. At the same time, OPEC's ability to coordinate production, and therefore influence prices, will likely weaken. This could lead to increased competition among oil producers, reduced price control by OPEC, greater market-driven pricing dynamics, a shift in global energy power. The UAE's exit also signals a broader shift in the global energy landscape. Non-OPEC producers such as the United States, Brazil and Guyana are already increasing output, gradually eroding OPEC's dominance. By stepping away from the cartel, the UAE positions itself as a more agile, independent player able to compete for market share rather than coordinate supply cuts. The move could even encourage other members to reconsider their positions, potentially triggering further fragmentation within OPEC. Winners and losers. Potential winners. Oil importing countries, more supply could ease prices over time. Consumers, lower fuel costs are possible in the long run. Independent producers, a weaker OPEC means less coordinated competition. Potential losers. OPEC members, reduced influence over global oil pricing. Saudi Arabia, its leadership role may be challenged. Market stability, increased competition could lead to greater price volatility. The bigger picture. Ultimately, the UAE's departure reflects a changing reality. The global oil market is becoming more fragmented, competitive, and less controlled by traditional alliances. While the immediate effects may be muted due to ongoing geopolitical turmoil, the long-term implications are profound. The balance of power in global energy markets is shifting, and OPEC's grip is loosening.